The evidence is building that home prices are on their way down. Hello again, I'm Martin North, the Principal of Digital Finance Analytics. Today has been another quite intriguing day with more information coming out which just underscores how precarious home prices are. We start with the Royal Commission inquiry into financial services misconduct, which sat again today. And I think it's worth just pausing and remembering why this commission was put into play. This is what Malcolm Turnbull said last November.
Now, the banks, of course, do not believe an inquiry is necessary, but they have raised, and you may have seen their letter to us, serious concerns that the ongoing uncertainty is undermining the financial system. Those institutions are the bedrock of the economy. There'd be very few Australians who are not a customer or a shareholder of the banks. Many of us are both, with almost every worker holding bank shares through their superannuation fund. The banks employ more than 200,000 people alone. Now, the speculation about an inquiry cannot go on. It's moving into dangerous territory where some of the proposals being put forward have the potential seriously to damage some of our most important institutions. We have got to stop the banks and our financial services sector being used as a political football.
So the idea was the Royal Commission would take away some of the uncertainty in the industry and allow it to focus on its future growth. But in fact, the evidence so far has been so damning that, if anything, the level of uncertainty has continued to increase. And in fact, the bank share prices are taking a bit of a hit at the moment. Today, ANZ was asked about its mortgage underwriting practices, and in particular those relating to mortgage brokers. And there were some quite astonishing revelations. Firstly, ANZ admitted that even if the broker gathered expenditure information from a client, they wouldn't really look at it when the application came into the bank, provided that it met the household expenditure measure test.
I want to put to you, Mr. Rankin, that your processes or your lack of processes in relation to the verification of a customer's expenses are non-compliant with the National Credit Act, responsible lending obligations, and with this regulatory guide issued by ASIC.
Yeah, I disagree. I think in a practical example, if you have a bank statement has a series of transactions on it, you have to identify which of those transactions, to the extent of what's more appropriate, manual review of bank statements versus taking a customer's stated level expenses and comparing that to an independently provided statistical benchmark. If we're interrogating a customer's bank statements, we're identifying individual transactions, we'd probably need to go back 12 months as some expenses are paid annually, not monthly. We then need to ask customers, what the nature of that transaction was individually. If it was above or below what we deemed their reasonable level, it would be a very highly complex situation. You'd end up then documenting various transactions individually as from the customer as to why they were or were not ongoing. If they're one-off, etc., discretionary nature items that they propose not to continue with, you'd have all that documentation. They then sign that rationale, and you're back to where we are at the moment, which is relying on a signed statement from the customer in any case.
Well, given how much you rely on that signed statement, Mr. Rankin, why do you bother asking the broker to submit the documentation? Because I think what we've just heard is it's put to one side, it's not analysed by ANZ, certainly not analysed from an expenses perspective. Why do you bother asking the broker to provide it?
We asked to provide the documentation for verification of income.
Of income.
And to the extent there's other financial liabilities that we're refinancing as part of the loan.
What it means in effect is that the bank was just taking what the mortgage brokers said and essentially putting all of the acid on them to get it right.
Can I come back to that basic question? what's in it for the broker to make sure that the client is telling the truth or facing the truth, not that the client's misleading, but that the client is facing the truth of her expenditure. There's nothing in it for the broker, is there?
If the broker at the moment is writing a lot of loans that go into default within a short period of time, that would come up on our dashboards and would warrant a detailed file review of their files. And if it was seen that they weren't exercising their obligations appropriately, we'd look to consequence manage of that, which could be disaccreditation with ANZ.
And then there was the case of a particular borrower, an elderly gentleman who needed $50,000 by way of a mortgage. And it's clear that the information that was received was partial and was quite questionable, but ANZ said that the application would still be passed even now. And then there was a more detailed discussion about HEM, household expenditure measures. And this is quite interesting because it's the benchmark that's essentially used across the industry to test levels of household expenditure in the context of, for example, a mortgage application. HEM is effectively a series of benchmarks. It's sort of based on the ABS data. And then there are a series of different types of households and different grades of expenditure. And it allows the bank to sort of benchmark the true expenditure being stated on application against the benchmark. Now, you can ask yourself whether in fact doing that is sufficient due diligence to discharge their lending responsibilities. I suspect that the Royal Commission will have something to say on that. But it's clear to me that HEM is potentially a significant risk area, because what it means is that it's quite possible for the real expenditure in a household to be a lot higher relative to HEM and it not necessarily be picked up. And this really goes to the underlying question, which is, can you trust the information on mortgage applications to make valid assessments from? And it's interesting that if you look at the mortgage power calculators on the bank's websites and compare the amount that you could get for a given set of income and expenditure variables now compared with a year ago, that value has gone down by about 20% on average, some more, some less. So the banks have been quietly tightening their underwriting standards. And what it means is that if I got a loan 2 years ago on a set of base assumptions, if I went back to get that mortgage now, the chances are I'd only be able to get a lower mortgage. Think about the implications for that when it comes to, for example, refinancing or moving from an interest-only loan to a principal and interest loan. This is a very significant issue. And perhaps up to 40% of loans are actually out of kilter when it comes to the expenditure calculations. The Royal Commission also looked at CBA and the way that it sold add-on insurance products. And whilst the particular product discussion was interesting, what was more interesting were the cultural norms inside the organisation. In fact, the new CEO sent out a message to all members of staff in CBA, warning them that this would not be good news, that the bank would be cast in a bad light, but he assured staff that steps were being taken to do the right thing for customers. It's an amazing omission, really, and it just shows you how far the cultural norms inside some of these organisations have atrophied. And there was other information today which also underscores the precarious nature of the property sector. Moody's came out with a report that suggested through this year they now think that house prices in New South Wales could fall 10% or more over the next 12 months. That's very significant from what they'd said previously. And they argue this is because of the high run-up in home prices and also the income expenditure issues that households are facing. In fact, if you look at the auction clearance data for last Saturday, you'll see that the overall clearance rates were lower again, even if volumes were up a little. But there's another factor here. If you compare the number of properties listed with those that are actually sold at auction, then the clearance ratio is significantly lower than those quoted by the industry. I'm going to talk about this in more detail in a separate blog because I think it's time that we get to the bottom of how these clearance rates are calculated and whether we can actually believe them or not. It's also worth noting that those properties that are being sold at a more significant discount, up to 7 to 10% below the asking price. And we also note that there seems to be a bit of a rush of people wanting now to put their properties on the market, perhaps because they believe that they will get a better price now than in 3 or 6 months' time. All this does not bode well for the next 12 to 18 months for the property sector. And it will be interesting to ask what the regulators, RBA, APRA and ASIC, do. For example, will the RBA be forced to cut interest rates to try and keep some momentum in the property sector? Will APRA tighten macroprudential standards further because of the very poor lending standards and the risks to financial stability? Or will they try and encourage lenders to lend a little bit more to keep the ball in the air for a little longer? And what about ASIC? Because ASIC has been doing some really good things in terms of trying to look at conduct within financial services, but they've tended to look at it from the point of view of the bank or the lender, not from the consumer side so much. And it seems to me that we are missing a consumer champion in the Australian financial sector. It'll be interesting to see whether ASIC steps up for that. So we are, I think, at a very interesting point in the cycle when it comes to property prices. And the more evidence that comes out from the Royal Commission of bad lending behaviour, and the more we see of home prices sliding, the more I think that we're in for a significantly bumpy ride over the next 12 to 18 months. And remember that my base case is still of prices down 15 to 20% over that period, and not just in Sydney. If you found this useful, please do like the post and leave a comment. And if you subscribed already, terrific. Thank you very much for doing that. And if you haven't subscribed, please do so to receive future updates. I'm Martin North, the Principal Analyst at Digital Finance Analytics. Many thanks for taking the time to watch.